we're joined now by Henry Laas. He's Chief Executive Designate at Murray & Roberts, who takes over from Brian Bruce from tomorrow. Thanks so much for joining us, Henry, this afternoon.
Thank you very much.
Well, of course, we've had the markets take kindly to the announcement you made yesterday, concentrating more so on the fact that you've managed to reach now new agreements on several contract disputes that will improve cash flow for the company, as opposed to the earnings and the numbers being anticipated. Is this the beginning of a new road for Murray & Roberts?
You know, when it was announced that I would take over from Brian, I started to develop a plan for the group, which I refer to as a plan of recovery and growth. And the first year is a recovery year, and that primarily relates to a recovery as far as our liquidity position is concerned. So we've applied our minds to develop a plan and a program to do just that. And we are very pleased with the success that we've achieved over the past couple of months. And a lot of cash has flown into the organization towards the second half of June as a consequence of all these settlements that we have achieved. And that to us is very positive, because the immediate challenge we had was the liquidity position of Murray & Roberts, which we had to address. And I see that as a very positive step.
So with you at the helm now, and of course with this new plan well underway, I mean, we're seeing an improvement in the group's cash position, where net debt stood at around about just over 1 billion rand at the end of December. What's your debt position as it stands right now?
Well, we're going into a closed period tomorrow. I can't tell you exactly what the net debt position will be, but will be several hundreds of millions less than the position we had in December. So it was about 1.1 billion in December, but it will be significantly less.
Having had this experience with Japan's Hitachi over costs related to subcontracted work, and then the experience as well with Seckam, what has been the biggest lesson learned here? Because that would inform how you mitigate against risks like this moving forward.
I don't think the risk that we encountered there could have been foreseen, because as we entered into this program, we basically started on a virtual design. And that is what the tender was based on. And as we started to build the project, the design was firmed up, and the consequences of the new design impacted us in the way that it has. So we had to deal with the consequences of that, and it did translate into a commercial settlement and a commercial arrangement. So what we agreed with Hitachi is a different outcome to what we achieved with Seckam. And with Seckam, it's basically a commitment and an agreement to a process to deal with the consequences of the change. And with Hitachi, it's really a full and final settlement, dealing with the issues of the past up to the 30th of June, but also a new commercial arrangement into the future, which I believe puts us in a position that we will be able to complete our responsibilities in terms of our contract with Hitachi within our margin aspiration of 5 to 7.5%.
Okay, well, all of this still within a very trying and difficult operating environment, and that economic cycle is something that's really not within your control specifically. So what's your reading of where we're at in this cycle?
To answer that question, you need to understand that Murray & Roberts is a diverse group. It is a global business, and what we do have is in our construction sector various businesses. The mining part of it, represented by the cementation group, is playing in the global market in the minerals sector, and the minerals sector is very buoyant. So we are confident that that part of the business has got a very interesting future ahead of it, and strong demand for our services next year and in the short to medium term. Then we also have an investment in Clough in Western Australia, which is in the oil and gas market, and that's also a market that's very strong at this stage with very, very strong demand for our services. But when you get to the other part of the construction sector, that's where we play in the local construction economy. It still is very depressed, it is very tough, and I don't expect to see a recovery or an improvement over the next 12 months. I expect it in about an 18-month time period.
It's out of that, you know, that's been born the fact that there's a big reliance from all construction players on big spend out of government that we're just not seeing. We hear of, you know, that kind of infrastructure spend in every budget reading, and you're still not seeing the impact of that?
We have not really seen much coming through at this stage. We do know what was announced in the budget speech the beginning of this year, over 800 billion. But we must understand that South Africa has got a task ahead of itself, and that is to meet the power demand that is necessary to support our economy to grow into the future. So although we have not seen any new opportunities really coming to the market, we believe it is imminent. We have the nuclear program that has to start in the not too far future, and Renewable energy is also something that we need to commit to. So I think it's a matter of time. But we are all disappointed in that these opportunities have not yet really come through to being tendered. It's
really with that being the case that we've seen this heightened competition emerge for the work that's out there, and where that competition for work heightens, we've got margins coming under pressure. So yes, run us through the margin pressure you're under at the moment and how that's contributing to your losses at this stage.
Again, to answer that question, you need to understand that certain parts of our business do not experience the margin pressure that you were referring to. It is really in the civil construction and the building part. And that component of the business contributes about 20%, 25% to Murray & Roberts' profit. So it's not such a big influence on the entire group if you take into consideration the other sources of profitability or profits that we have within the group. But the margins are low. It is competitive out there, and the margins are very low. It is below our expectation, and the margin range of 5 to 7.5%. And we don't expect that really to improve over the next 12-month period. So it will remain low.
Where that construction space specifically within the business is under pressure, to what extent are you looking beyond South Africa's borders, and this specifically pertaining to African expansion?
Now, we have identified the opportunity that Africa does present Murray & Roberts as a group. And we are in the process of formulating our strategy, how to engage the continent of Africa in a constructive way. It's a continent with 53 countries, and when you talk about Africa, not all places in Africa is attractive for us to go. So we're part of that plan, but yes, the intent is to look beyond the SADC region.
Okay, well, the market is probably pricing in that the worst is over for Murray & Roberts, and that this is, the last pain that the company can take. What's your outlook for the year ahead?
The year ahead is really going to be a year for me where we need to address our cash position. And I'm confident that we will be in a significantly better liquidity position by June next year, which is the end of the new financial year. From a profitability point of view, the profits will definitely also be up because of the growth that we anticipate in the other sectors, such as the mining business, from our investment in Clough. There will definitely be strong growth coming from those sectors. But we don't expect growth in our local construction part of the business. So on average, we do expect reasonable growth in the new financial year, but it will not come from the construction sector in South Africa.
Well, Henry, thanks so much for your time this
afternoon,
and best of luck to you as you take over the reins officially tomorrow.